And joining me now to talk more about the markets as we hover right near record highs is Callie Cox. She's Chief Market Strategist at Ritholtz Wealth Management. Callie, always great to see you, especially in studio. Welcome.
Yeah, it's great to be here, especially after the opening bell. Always a fun time.
Always a good time indeed. And let's talk about these stocks because they have certainly taken off since the election, right near record highs. A bit of a breather these past few sessions or so. What is your view on the market right now?
Well, I like the breather. We've been through a lot this year, so I'm enjoying the quiet. It is really interesting, though, that we've seen stocks basically move straight up since Election Day. I don't think anybody had that on their bingo card. But it's a reflection of the, anticipation of a more pro-America, pro-growth policy.
Yeah.
It doesn't seem like markets want to consider the nuance there. Of course, tariffs and tax cuts could be more of a boost to inflation, and inflation is the biggest boogeyman that we've had over the past few years. So, I'm watching things happen, watching things settle. A little surprised that we haven't seen, many more ups and downs than we have.
It's interesting. This is always a very common time of year, right? End of the year in December, early in January, for people to look at their portfolios, make moves, adjustments if necessary. And of course, we have a new administration coming in January. I want to hear from you the expectations going into 2025 and what some of those perhaps lofty expectations might ultimately mean for investors.
Well, you're right. Expectations are high, and it's great. I mean, it's good that we're in a place where everybody is happy. They're expecting good things next year. Company profit expectations are quite high. S&P earnings are expected to grow by double digits. Economic expectations are much higher than they were a year ago, which is great. That means that, the economy has made it through a really tough time. But that can be a double-edged sword for investors because when the bar is high, that means that there's more room for disappointment.
In terms of what could be disappointing, I want to hear from you on the jobs market, on earnings as well, because we know fundamentally that is historically what has fueled the overall S&P 500.
Yeah, well, I want to be clear. I want us to exceed expectations and I want stock prices to go up. And I think that there's a good chance that they will next year, as long as the economy stays afloat. But right now, like I said, company earnings are expected to grow by double digits. Profits are expected to grow in every single sector. We haven't seen that in 7 years. And if that happens, that's great. But if you have a company that's performed really well over the past 2 years and loses a bit of momentum heading into next year, then I'd be a little nervous about getting some of those negative surprises. Tech is a sector that comes to mind that has an especially high bar. And Kristen, you mentioned the job market too. I mean, it's great that the job market has been so strong, but at the same time, there are signs of weakening, and I think some people might be overlooking that.
Yeah, and I want to talk about what that might mean for Fed policy. Of course, we know the Fed has a dual mandate, jobs, full employment, and inflation as well, historically near 2%. Still a little bit elevated above that. We'll get the consumer price index data tomorrow. Markets, by and large, do anticipate another rate cut by the Fed next week. But what could this mean for Fed policy long term in terms of the rate cuts that we may or may not get?
Yeah, the Fed has done a really good job so far. And you can see that through the job market staying afloat, inflation coming down back to that 2% mark. Obviously, prices are still high, but the economy is healing slowly. I'm not sure we're anticipating enough what the end of the rate cut cycle could look like. And I think the Fed will cut rates into the first half of next year. Obviously, if the job market falls apart, the Fed will have more incentive to cut rates, implement larger cuts and then maybe cut a little bit longer. But we're getting close to neutral. We're at 4.75 right now. Fed members think neutral is between 3 and 3.5. That's 5 to 7 rate cuts from now, and we have 8 meetings next year, including the one that's coming up next week. So you put it all together, the Fed has a good reason to keep gradually cutting rates, but I think we might be overestimating how long this era of hopes and dreams and rate cuts could last.
And I'm curious in terms of where we are in this cycle, Callie, what that might mean for some of these unloved sectors that haven't performed as well as technology.
Well, that's where we are in the cycle is a very difficult question because every piece of the economy seems to be in a different step. The job market is slowing. It's under a lot of pressure still. Corporate profits are growing, which makes me a little more hopeful that, this job market slowing could be gradual. But people are having trouble finding jobs. We're not seeing mass layoffs, but we're seeing the beginning of a worrying moment in the job market. If you look at the housing market, the manufacturing sector, those haven't really taken off. They've been frozen by high rates, high mortgage rates. And then you, of course, have companies who have kind of already been through their recession. They've seen profits drop. So we're having to digest a lot of conflicting signals here. And when that happens, you have to look back to market fundamentals. Look for value in markets. This bull has been lopsided. 1 in 4 stocks has outperformed the index. So look at the stocks that have been lagging, understand why they've been lagging, and look for that value.
Callie Cox, always great to see you, especially in studio, of course. Callie is the Chief Market Strategist at Ritholtz Wealth Management. Thank you.